So traditionally, it's been technology and consumer discretionary stocks that have been the growth engine of stock markets, especially the US stock markets. But recently, there's been a brand new sector that has emerged as a new growth sector. What is this, and is there a lot of profit potential? Let's take a closer look. Now, as many of you would know, the US market is divided into 11 sectors. You've got, for example, the technology sector, the financial sector, the consumer discretionary sector, the energy sector, and so on and so forth. And of all those sectors, one of the most boring sectors that I never invest in historically has been the utility sector or utility stocks. Why? Because utility stocks are basically companies that provide essential public services like electricity, natural gas, and water. And historically, for the last 20, 30, 40 years, it has been one of the lowest growth sectors. Why? Well, because typically electricity demand grows at 0% to 1% per annum, right? So how much can these companies grow if the demand is growing at 1%? At the same time, many of these utility companies, their prices are set by regulators. So they can't just raise prices if they want to. It is set by the government. And as a result, the stocks grow at a very slow and steady pace. And historically, people tend to buy them just for dividends, not for growth. And also to kind of like recession-proof the portfolio, because typically utility stocks are very defensive. In a worst recession, you still need electricity, you still need water, you still need gas, right? So for example, if you take a look at the utility ETF, ticker symbol XLU, you can see again historically in the last 10 years, it underperforms the S&P 500. So as an investor, if your job is to beat the S&P 500, why would you want to buy a sector that can never outperform the S&P 500? Yeah. So what kind of stocks are in the utility sector? Well, if you take a look at the XLU ETF, you can see their largest holdings over here. You've got examples, NextEra Energy, Constellation Energy, Southern Company, Duke Energy, American Electric Power, Sempra, Vistra, Dominion Energy, just to name a few. However, recently something has changed, right? Suddenly this sector, well, not the whole sector, but certain companies in the sector, they've become really exciting. They've become like growth stocks. So for example, if you look at some of these utility stocks like Talon Energy, ticker symbol TLN, Vistra Corp, ticker symbol VST, Constellation Energy, ticker symbol CEG, and NRG Energy, ticker symbol NRG, in the last 1-2 years, they have way outperformed the S&P 500. You can see the S&P 500 up 46% in the last 2 years or so. But these companies up 500%, 300%. What the heck is going on? Now, first of all, some of you would say, but aren't these energy companies? Isn't this under the energy sector? No. These are not energy companies, these are utility companies. So what's the difference? Now, in the financial world, energy companies refer to companies like ExxonMobil, like Shell, like Chevron, where their main business is actually in extraction of oil and natural gas. So their output would be oil and natural gas, which are very, very cyclical. Whereas these companies, their output is not oil and natural gas. Their output is electricity. So yeah, they use nuclear energy, they use oil as their input, but their output is electricity. So they are utility companies. They are not energy companies as defined in the financial world. So just to clarify that, right? And as a result of some of these high growth in these utility stocks, you can see that the overall utility sector has grown at 16.73% in the last year, which is pretty interesting because historically it's been, again, the lowest growth, but now is beginning to grow at double digits. So what has changed? What happened to this entire sector? What happened to these utility companies? What changed? AI, right? The AI revolution. So while everyone is looking at semiconductor chips, they're looking at AI stocks like Palantir, but at the same time, these utility companies are benefiting from the AI revolution, as well as electrification in general. Why? Because remember that AI requires data centers, and these data centers require a tremendous amount of power and electricity. So in fact, global data center electricity is projected to double to 945 terawatts by 2030, which is a growth of 15% a year. So think about it, right? Historically, power has increased, or rather electricity has increased at 1% a year, but now it's going to be 15% a year because of the demands of electrification as well as AI. And again, we're at the early stages of this entire AI revolution, robotics, automation, all this tremendous amount of power. Now, the question that I ask, and the question you have to ask is, this sudden growth in these utility stocks, right, the demand for power, is it cyclical? Which means, does it just grow short term and then mean reverts to the longer term trend, which is slow growth? Or is this a structural change? Is this an increase that can be sustained for the next 10, 20 years? That's the question. So what I think, and from my research, it appears that this is a structural, long-term change and not a short-term cyclical change. Why? There are three main tailwinds that are driving the demand for electricity. Number one, I mentioned AI, data centers. So inference, enterprise AI adoption, cloud migration can keep data center demand for electricity growing for a long time, 10, 20, 30, 40 years, and you only get even more in the future. The second tailwind is electrification stacks on top of AI. For example, electric vehicles. As more and more vehicles go electric in the future, you need more electricity, right? Heat pumps as well as industrial electrification in many regions of the world. And the third, specifically to the US, is domestic manufacturing. As all of you know, the Trump administration is getting factories to come back to the US and to get companies like even TSMC, Taiwan Semiconductor, to manufacture semiconductors in the US. So we call this reshoring of factories to the US, and this increases the demand for electricity. Now, in case you're wondering, how much is 1 terawatt hour? Well, 1 terawatt hour is equal to 1,000 gigawatts. Remember Back to the Future when Doc Brown said, I need 1.21 gigawatts to send you back to the future. So this is 1 terawatt is 1,000 gigawatts, okay? And 1 terawatt hour is required to run 100 million homes for an hour. That's how big it is. And you can see that the projected data center usage, just data center alone, is 945 terawatt hours. That's a tremendous amount of power, right? Now, but are we just going to go out there and buy utility companies? No. Yeah. So bear in mind that utility stocks, there are two types of utility stocks. You've got traditional regulated utility companies, and these are the ones where the profit margins and their pricing is regulated. They can't raise prices as and when they want. It's regulated by the government, the state government. So companies like Next Era Energy, ticker symbol NEE. We have got companies like Southern Company, ticker symbol SO, Duke Energy, DUK, and Sempra SRE. These companies, they can't raise prices, their profit margins are fixed, so they will continue to be low growth companies. So these are the ones that I would not want to invest in unless I just want to get dividends, okay? But if I want to invest for growth, I want to look at only the IPPs, which are the independent power producers within the utility sector. So what's the difference? The difference is IPPs, they own their own power plants, obviously, and they sell electricity at market rates, which are unregulated. The government cannot control the rates they set. They can sell at whatever price they want. And when data centers run by Meta or Amazon or Microsoft Azure, when they're desperate for 24/7 power, these companies have massive pricing power. They can raise their price, and these big hyperscalers and data centers are willing to pay anything to get the power. And many of these IPPs, they own the existing nuclear power that AI data centers crave, because nuclear power, as you guys know, is the only form of power that is constant and uninterrupted as compared to other forms of power like solar, for example, right? So which companies are IPP companies within the utility sector? You've got a couple of them. One of them is Constellation Energy, which is the main one, the biggest one, ticker symbol CEG. You've got Vistra Corp, ticker symbol VST. You got NRG Energy, and you got Talent Energy, which I mentioned earlier on before. So let's take a closer look at these stocks, because you don't want to just blindly go and buy a stock because you think that, oh, the whole sector is going to go up, there's a lot of demand, let's just go buy the stock. That's one of the classic mistakes that investors make. Ultimately, before you buy a stock, a business, you have to analyze the business. Is it a high quality business that meets your investment criteria? And is it a long-term investment, or is it just going to be a short-term trade? Of course, if it's a short-term trade, you don't really care about the fundamentals, just look at the price action, enter when you got a low-risk entry point, put a stop loss, put a profit target, that's it. But if it's an investment, you have to do deeper research. And of course, if it's an investment, then there's no stop loss, there's no profit target. You just buy and you keep adding it and let it compound for the long run. So it really depends on your objectives here. So let me analyze it from an investment perspective at this point of time. So let's look at the granddaddy of them all, Constellation Energy, ticker symbol CEG. So going to Stock Oracle, straight off, you can see that it's got a narrow economic moat, which is okay, pretty good, right? But you can see it is currently overvalued, right? The intrinsic value is 193, and currently it is selling at 354. So it's a bit overvalued right now. Now, if you want to calculate your own intrinsic value or use other valuation methods and not just rely on Oracle value, which is the proprietary algo in Stock Oracle, you can do that as well, right? So if you click on intrinsic value, you can use whichever method that you want, right? So for example, if you say, I want to use a mean price to sales ratio method, well, that gives you a valuation of 193 as well. If you want to use a mean price to book ratio method, then it's worth 200. You want to use a discounted cash flow method, is worth 258. So you can use whichever method that you want, but notice that whichever method you use, the stock price is above all the different valuation methods. And of course, this is based on the fact that FactSet, which is the data provider to Stock Oracle, projects that Constellation will grow at 15% a year in the next 3 to 5 years and grow at 15% a year in the long term. That is the projected growth rate that's used to calculate the intrinsic value. Now, if you think that, oh, it's too pessimistic, I think they're going to grow a lot higher, they're going to grow at 30%, 40%, sure, you can always calculate your own intrinsic value, right? So for example, you can use whichever method you want. You can say, okay, I'm going to use a discounted net income method, for example. And instead of the growth rate of 15%, I'm going to put a 25% growth rate. For example, if you're very optimistic and you can calculate and come up with your own intrinsic value based on your own growth projection, right? So again, Stock Oracle allows you to calculate your own intrinsic value if you want to, yeah? And if you want to find out more about the moat, how strong is the economic moat, again, you can go to Oracle IQ over here. And you can click on the AI moat, where it will tell you what are the sources of the moat of the company. Again, what is moat? Moat means its competitive advantage, what allows it to protect itself against competition that can take away its market share in the future, right? So the stronger the moat, the more it is protected against competition. So bear in mind that companies with no moat, in the short term, they can make a lot of money, they can grow very fast, but in a longer term, in 5-10 years, they could be disrupted by competition. That's what no moat means. So when it comes to short-term trading, I don't care about the moat. Whether is it wide moat, narrow moat, I'll still buy if it's a short-term to medium-term trade. But if I'm investing for the long term, for the next 5-10 years, then I only want companies with a narrow or wide moat. So I'm assured that it can't easily be disrupted by competition in the future. All right, so that's how we use the moat. So if we look at Constellation Energy, for example, you can see again the moat score is 6 out of 10, and they've got high barriers to entry. They've got a huge economies of scale. So these are the two main sources of the moat. Now, what is also great is you can also take a look at the AI analysis over here, AI Insights, and you can look at the bull thesis and the bear thesis, right? So what are reasons to buy the stock and what are reasons not to buy the stock, right? You have to always look at two parts of the argument and see which is stronger. So if you think that a bull argument is stronger, then something you could think about. You can look at what are the growth drivers, what is going to drive the growth of the company in the future, as well as what are the investment risks. Every business, every stock has risks. So what are the short-term risks and what are the longer-term risks? That's really, really important, right? And of course, if you look at the chart, you can see that, in the last 3 years, you can see that, it's been on a very strong uptrend, outperforming the S&P. In the last 1 year, it's also been on an uptrend, but it's been kind of like consolidating recently before it could potentially break out again, right? You can also take a look at the financials. Again, for me, when I invest in a company in the long term, I want to make sure it's got very predictable growth in revenue, profits, and cash flow. If you look at the financials, for example, over here, and you can look at the line chart or the bar chart, it's up to you. You can see that, again, historically, it's been not that high growth. But recently, because of the AI revolution, it has recently, in the last 2-3 years, grown strongly in terms of revenue as well as the profits, right? You can see over here, it's recently that the net income has begun to slowly go up, whereas historically it's not been that profitable before AI came about. All right, so that is Constellation Energy. Let's look at the rest. If you look at the rest, like Talent Energy, you can see there's no moat. So what does it mean? It means that, short term, it can grow very fast, it can make a lot of money in the short term, but in the next 10-20 years, it could be disrupted by competition. Bigger competitors could take away their market share. That's what no moat means, right? And you can see that, this one doesn't appear to be as overvalued, right? This one looks like, it's overvalued. What am I talking about, right? Yeah, so Oracle value is 176, right? It's 395. Again, it's currently a bit overpriced, all right? And you can see the PE ratio is like 86 times, the forward P is 19. Forward's pretty low. That's not too bad. Again, if you look at financials, you can see that historically, it's not been very consistent. The revenue has gone up and down. The profit, lost money, made money, free cash flow has been very inconsistent. Okay, so it doesn't really meet the criteria of most of the companies I like to buy. I like to buy companies with consistent revenue growth, consistent profit growth, consistent cash flow growth. But this is not yet consistent. Why? Because it's the AI revolution only just started. So it's only recently that they've seen growth in revenue and profits, but they don't have that history yet that I like to see in most companies, right? Okay, if you look at Vistra Corp, same thing, there's no moat, but very high growth recently. You can see the projected growth in the next 5 years is 19%, and long-term, 47% growth. Very high growth company, right? Talent Energy, short-term growth 15%, long-term growth 29%. So these are high growth companies, very high growth, but they're more speculative because they don't yet have a moat to protect them in the long term. But they are very high growth right now, and they're quite overvalued, right? And same thing with NRG Energy, no moat, right? But very high growth, right? They don't have a long-term growth projection, but short-term growth 15%. And again, it's overvalued. So you can see that the majority of these stocks, besides Constellation, the rest of them have no moat. They are overvalued, and they don't yet have a consistent cash flow and profit track record, right? But they're very high growth. So in cases like that, would I invest in the individual companies? Usually I wouldn't want to. I may trade them for short-term trading, but for long-term investment, to me, I think it's a bit risky. Okay. However, if I think that the whole sector, okay, is in a secular growth phase, then I look more to buy an ETF that can diversify my risk rather than all my eggs in one or two companies, to diversify into some of these companies. So I can look at ETFs. Now, would I want to buy the utility ETF, the XLU ETF? No. Okay. Why? Because remember that the utility ETF XLU, if I put in XLU, recall that this ETF will not be able to beat the S&P 500. Why? Because this ETF, it doesn't just consist of the IPPs, which are the high growth power producers. They also have a lot of these traditional regulated utilities that are slow growth, profit margins are fixed, that will slow the growth down. So because of that, I only want to invest in an ETF that has this one but doesn't have this one. Now, nowadays there are many ETFs, and of course this is not a recommendation for you to buy any of these ETFs. I'm just sharing it for educational purposes, but these are 4 of the more popular ETFs that contain those independent power producers. So for example, you've got this ETF, AIPO, where their strategy is investing in AI infrastructure and grid components. So this ETF doesn't just contain the independent power producers, which I mentioned, like CEG, VST. They also contain companies that make the infrastructure and hardware to handle the power, which are basically the grid, right? So it's a full ecosystem, not just the power producers, but you're also owning companies that provide the hardware and the grid engineering to handle that power, right? So how much of this ETF is concentrated into the IPPs? Roughly about 15 to 20%. Now the other ETF is UTES, which is an active utility management. So this ETF has the highest concentration into the IPPs, which is about 36% into, again, CEG, VST, and TLN. This is more of a pure play, high conviction bet on the IPPs and not adding in the other hardware and infrastructure players, which are more within the industrial sector. Then another way to play this is the nuclear and uranium focused ETFs like NLR, as well as another one, NUKZ, which I've been selling cash secured put options on, as I share in my Ultimate Investors Playbook community. So this particular 2 ETFs, NLR and NUKZ, they don't just consist of the IPPs, but they also have got uranium producers like Chemical Corp, ticker symbol CCJ. And the last option would be to invest in broad utility ETFs like IDU and, as mentioned, XLU. So this doesn't just consist of the IPPs, they also consist of the traditional regulated utilities. And so you may say, which is the right one? There's no right one. It depends on what you want to focus on, right? You just want to focus on IPPs, then this is the one. You want to focus on IPPs and grid infrastructure and industrial components that handle the power, then is AIPO. If you want to invest in IPPs plus some of the nuclear and uranium stocks, then it's more of NLR. And the last one is a broad approach, but of course this has got the lowest growth. If you take a look at the last 1 year, you can see that NLR, which is the one that consists of the nuclear stuff, that has way outperformed, has the biggest performance versus the S&P 500, SPY. And next in line would be UTES, which I mentioned. Of course, the last would be XLU and IDU. Now for AIPO, notice that it only listed here, right? It only listed here back in July. So you can't compare it with the rest 1 year later, right? So if you want to compare AIPO, then you have to drag the chart where everything starts in late July. So if I drag the chart to July, yeah. So you can see that based if you, from there, sorry, late July, right, you can see again NLR has the highest return because it includes a lot of the nuclear and uranium stocks that are right now really exciting. And then second would be AIPO, beating the SPY. But these three have underperformed the SPY recently, all right? So personally for me, I actually bought the AIPO some time ago. For those of you who are in the UIP, the Ultimate Investors Playbook, my private community, you would have gotten my alert exactly when I bought AIPO. Again, this is not a recommendation for you to buy. It's an analysis of the sector and sharing with you my thought process of when I buy ETFs versus individual companies. Thank you for listening and have a great year ahead. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.